Have you ever wondered if it's actually possible to retire early just by living off your stock dividends? What if we told you there's a proven investing strategy that can make it happen? We call it the Dividend Snowball, and it uses the power of compounding to turn a small starter portfolio into hundreds of thousands in dividend income, funding your dream retirement decades earlier than traditional plans. Hello and welcome to our channel. We're so glad you could join us today. We're going to be talking about an awesome investment strategy called the Dividend Snowball that can help you live off dividends from your stocks fast. Now, you've probably heard how compound interest works before. You earn interest on your money, then that interest earns more interest, and it grows exponentially over time. The same thing happens with stock dividends when you reinvest them. It's like a snowball rolling down a hill, getting bigger and bigger. Pretty cool, right? In this video, we'll break down exactly how the Dividend Snowball works and how you can get it rolling for your portfolio. We'll look at the power of dividend reinvesting over long periods of time. We'll also give you some tips for picking the best dividend stocks to maximize your snowball effect. The best part is this strategy doesn't require tons of capital to get started. You can begin with just a little bit of money invested and let the dividends start compounding. In 20 or 30 years down the road, those dividends could fund your whole retirement. How awesome is that? Alright, before we get into the nitty-gritty details, here's a quick overview of what we'll cover. How does the Dividend Snowball work? First things first. What exactly is the Dividend Snowball and how does it work? Basically, it's when you take the cash dividends that your stocks pay out and use them to buy more shares of stock. This builds what we like to call a positive feedback loop. As you earn more dividends, you buy more stock. More stock means bigger dividend payouts. Bigger payouts let you buy even more stock, and the cycle repeats. Like a snowball rolling downhill, it starts small, but keeps picking up speed and mass. Now, why does this work so well? There are two big reasons. Number one is the power of compounding over very long periods of time. Even modest returns like 6 to 8% per year compound into huge sums when reinvested annually for 20, 30 plus years. Let's think through a quick example. Say you invested $10,000 into a stock with a 6% dividend yield. In the first year, that would pay you $600 in dividends. If you take that $600 and use it to buy more stock, now your total investment is $10,600. In the second year, a 6% dividend on $10,600 is $636. Reinvest that, and your total grows to $11,236. And so on. The dividends keep getting bigger along with the underlying investment. In 25 years, your original $10,000 could easily turn into over $50,000 just through the magic of compounding. This brings us to reason number two. Companies that pay steady, reliable dividends tend to increase them over time. It might just be 1 or 2% per year, but over decades, that really starts to accelerate your snowball. The earlier you start, the bigger your snowball gets. Picking the best dividend stocks. Alright, so now that we've covered the basics of how dividend snowballs work, let's talk about picking stocks. Not all dividend payers are created equal. You want reliable companies with strong underlying businesses. Here are some tips. First, take a look at dividend aristocrats. These are S&P 500 companies that have paid and increased their dividends for at least 25 consecutive years. That's over 2 decades of steady payouts through good economies and bad, a true mark of stability. Popular aristocrats include Coca-Cola, 58 years of rising dividends, Procter & Gamble, and Chevron. Next, look at the dividend payout ratio. This measures what percentage of a company's profits or free cash flow goes towards paying the dividend. As a rule of thumb, you want to see ratios between 40 and 60%. Much higher, and the dividend could become unsustainable if business takes a downturn. Much lower suggests room for future dividend growth. You'll also want to eyeball the dividend yield. This is the annual dividend amount divided by the stock price, shown as a percentage. Yields in the 2 to 4% range are reasonable for stable dividend stocks. Be wary of extremely high yields over 5% though. That can signal financial troubles ahead. It's smart to pick companies across a variety of industries too. This way, your dividend stream stays steady even if one sector runs into issues. Staples like consumer goods, utilities, telecoms, and healthcare tend to do well. Real estate investment trusts, or REITs, also pay excellent dividends, sometimes over 5%. And most importantly, make sure to thoroughly research companies before investing to confirm their strong track records. Favor market leaders with distinct competitive advantages, consistent growth, and healthy financials. That's the trifecta for identifying great long-term dividend stocks. Reinvesting those dividends. Alright, so you went out and picked some solid dividend-paying stocks across industries. Now what? Now comes the fun part. Putting that dividend snowball into motion by reinvesting those payouts. Most brokerages give you flexibility in terms of what you want to do with your dividends. You can take them as cash payouts to spend or save, or you can reinvest them right back into more stock shares. This is the snowball approach we want. Reinvesting is super easy to turn on. For example, with a brokerage like Fidelity, you just log into your account, pull up a stock, and toggle the reinvestment setting on. Voila! From then on, any dividends paid out from that stock will go straight towards buying you more shares automatically. No extra effort required. Now, as those dividends start rolling in every quarter, you'll be turbocharging the growth of your holdings in two big ways. First, you'll benefit from dollar cost averaging. This means sometimes you'll be buying when prices dip low, and sometimes when they're a bit higher. But overall, your average cost basis will be lower than if you bought at sporadic points in time. And second, you'll ratchet up the compounding we talked about earlier. More shares equals bigger dividends, funding the purchase of even more shares. Rinse and repeat. It really starts to pick up momentum after a few years. One last tip here. Make sure to hold your dividend stocks in tax-advantaged retirement accounts whenever possible. IRAs and 401ks allow your dividends to grow tax-free over decades. An absolute must to maximize your snowball. Let's check some real-world numbers. Alright, so dividend snowballs sound pretty awesome in theory, but what kind of cold hard numbers are we really talking here? Let's run some projections and see what could be possible after 30 years of reinvesting those dividends. For this exercise, we'll assume someone starts investing at age 25 with $10,000 into a couple of classic dividend aristocrats, Coca-Cola, or KO, and Procter & Gamble, or PG. They contribute another $5,000 each year and reinvest all dividends. And we'll model future dividend growth conservatively at 6% per year. Not unrealistic at all based on their histories. After only 10 years, our initial $10,000 would grow to $203,000 thanks to compound growth. Our annual dividends would be about $12,000. Not bad. After 20 years, we'd be sitting on $830,000, generating $49,000 in yearly dividends. Now that dividend stream is starting to look like some nice fun money. And after a full 30 years at age 55, boom, we'd have a portfolio worth over $3.7 million. And those annual dividends would soar to over $220,000 per year, not even touching the principal. At a super safe 4% withdrawal rate, that would support $336,000 per year in retirement income. Absolutely life-changing. So let's quickly recap. By starting early, consistently investing each year, reinvesting all dividends, and tapping into even modest compound growth, our investor turned a $10,000 starter portfolio into over $3 million and $220,000 plus per year in dividends after 30 years. That definitely beats keeping your money in a savings account. And again, this example used just 2 mega cap stocks and conservative growth estimates. Imagine if you built a larger portfolio sampling other sectors like telecom and utilities too. Alright, the key takeaway. consistency and time are crucial. Like a real snowball, compound dividends start small but gain tremendous momentum over long rolling periods. The earlier you start investing, the bigger your eventual snowball. Even if you begin with modest savings like $5,000, after 30 years of diligent reinvesting, you could reasonably expect to generate tens of thousands per year in dividends. So don't wait. The time is now to put your money to work, plant those dividend seeds, and let the snowball effect go. Sign up for an automatic investment plan with your brokerage to put away what you can monthly. Turn on dividend reinvesting. Keep adding stocks gradually over the years and decades. Before you know it, that initial investment will have snowballed into a barge of cash funding your dream retirement. Sure beats letting your money waste away in a bank account. And one final reminder, because dividends can take many years to compound substantially, always invest with long time horizons in mind. Have a 5, 10, 20 plus year outlook. There will inevitably be market dips and crashes along the way. That's just part of the game. As long as your companies remain healthy, stay committed for the long haul. Well, that's all for today. And before you go, don't forget to like, subscribe, and turn on notifications so you don't miss any future investing videos. The channel has tons of great dividend content coming down the pipes you won't want to miss. All right, friends, thanks for sticking with us today. Stay tuned and we'll see you in the next dividend video.